Hi, I'm Roger Montgomery and welcome to this video insight. Back in November last year, I wrote this blog entitled, "If history is our guide, then now is a great time to invest." I revealed a convincing pattern through history of good years in terms of stock market returns almost always following very bad years. And last year was indeed a very bad one. I showed that the S&P 500's worst years in the last 150 were 1931, 1937 and 2008. Curiously, they were followed by the years 2009, 1938 and 1933, with the market rising between 20 to more than 50%. Let me quote from that November 22 blog. "Given where PE ratios are today, there's a genuine possibility investors who purchase shares in high-quality growth companies will not only benefit from the earnings growth produced by their selections, but also the re-rating at some point in the future to higher PE ratios." And I concluded that blog by saying eventually, indiscriminate selling gives way to discernment. Quality wins out, and history shows good return years follow years of poor returns. Standing on the sidelines may be a regrettable and costly error. Now that was November 4, and since then the S&P 500 has risen 21%. And the NASDAQ has had its best 6-month start to a year since 1983. In fact, the NASDAQ 100 is up 43% since that blog was written. Of course, with each rise and decline, there's a reason. And this time, the reason is technology and the intriguing demand for technology stocks by US retail investors. Despite the recent rally in tech that has driven the major indices higher, a recent survey conducted by investment platform eToro revealed that tech will likely remain a favoured sector for retail investors for the rest of the year. The survey of 1,000 clients revealed 23% of individual investors reported that they will, quote, most likely ramp up their investments in tech during the latter half of this year. Now, with earnings seasons upon us, the high prices of major technology companies will require some justification. Microsoft, Alphabet and Meta have demonstrated healthy spending on AI as well as a rise in their cloud business revenues. Microsoft's announcement earlier this year of its $10 billion multi-year investment in OpenAI led to a 44% rise in its shares. Meta stock has risen by an astounding 133% year to date, with Apple and Amazon up 54% and 50% respectively. Alphabet has seen a 36% rise. But as I pointed out in a more recent blog, the jury is out on whether the revenues earned from AI are transformational or just incremental. And the answer to that question will determine whether the euphoria gives way to more discerning questions about the fiscal implications of AI development. The benefits of generative AI to business are indeed enormous, so it's reasonable to assume companies will pay more for enterprise software that incorporates the technology. SAP, for example, suggests that by merging generative AI with the types of information SAP system stores, clients will uncover ways to reduce inventory, boost sales, and even improve carbon emissions. Already, the German retailer Schwarz Group, which owns Lidl and Kaufland stores, is using everything from its historical business data to consumer sentiment, inflation data and weather forecasts in conjunction with generative AI to predict demand. According to SAP's CEO, the results for Schwarz has been 15% better inventory management, a 20% decrease in waste and an uptick in total sales due to having the right products on the right shelves at the right time. As an example of the potential revenue impact for providers of access to the benefits of AI, SAP plans to charge 30% more on average to customers who use its AI features. Consequently, it sees AI doubling the size of its addressable market to reach $1 trillion by 2028. So it's clear that AI's influence on the market is far from over. But investors' patience over coming months will determine whether this tech rally is a bubble or whether it's well-founded on confidence in the sector's potential. And it's worth remembering that investors tend to overestimate the short term and underestimate the long term. That's all we've got time for today. I look forward to speaking to you again next week. And in the meantime, please continue to follow us on Facebook and Twitter.